Good afternoon, everyone, and welcome to the third in a series of 4 Federal Grant Administration webinars. This one titled Purchasing Goods and Services with Federal Grant Funds. I'm Dion Thompson-Davley, a program manager with the National Association of Development Organizations, and I'm pleased to be joined today by our speaker, Bob Lloyd. Because our speaker has a lot of ground to cover this afternoon, if you're not aware of NATO and our programs, I invite you to learn more by visiting our website at nato.org. And before I introduce Bob, I just want to go ahead and acknowledge that the webinar series and the sessions that we will hold on this subject at our conference are provided under our Economic Development District Community of Practice Initiative, which is generously supported by the U.S. Economic Development Administration. This webinar today will be recorded and we will post it on the NATO website and also send out a copy of the recording and the slides as we are able to after today's session. As I mentioned at the top, this is the third in a series of 4 federal grant management sessions. You may have noticed that we're a little out of order here. Unfortunately, we had to reschedule our October 2nd session, Indirect Cost Recovery for RDOs, due to the ongoing effects of Hurricane Helene on our staff and speaker. So we apologize for that, but look forward to seeing you on October 16th. You should be able to use the same registration link that you used for the session before. We'll also go ahead and send it out again in our post-session email. We also want to go ahead and apologize for the delay posting these sessions on the NATO website with their recordings. That has also been impacted by the hurricane and its impact on our staff. So we appreciate your patience. And again, we will be sure to get the materials to everyone who attended today. In addition to our webinar series, I want to highlight that we will be offering 2 Federal Grant Administration sessions during our upcoming annual training conference, which will be held in New Orleans from October 21st to October 24th of this year. You can learn more about that conference at nato.org/events. One of the sessions will cover the distinction between the roles of grant recipient, subrecipient, and pass-through entity, and the other will provide insights into the updated OMB uniform guidance. So without further ado, I'll go ahead and introduce our speaker for the webinar series. Once again, Bob Lloyd. Bob is likely familiar to many of you as he's been an important fixture at many of NATO's conferences and events over the years. Not only is he a respected authority on policies and practices that affect the award, administration, and oversight of federal grants, contracts, and subawards, he is also a strong advocate for the work that RDOs do across the country and for the work that NATO does for RDOs. His bio statement is included in the slide presentation, and we will make sure we make that available to everyone after today's session. Because we have a lot of material to get through, we ask that you hold your questions to the end until the end of today's session. What you can actually do is go ahead and drop them in the chat, and we will make sure that if we have time at the end, we will get them to Bob. He also would like to offer his email address for any questions that we don't make it to during today's session, and so we'll make sure we get that information to you as well. Finally, please be sure to complete the webinar evaluation that you should receive at the conclusion of this webinar. And so with all that, please join me in welcoming our speaker, Bob Lloyd.
Well, thanks, Dion. I appreciate it. And it's good to be back with you for this rescheduled session of the webinar series. I, among others, was affected by Hurricane Helene. My home was out of power for 8 days, no internet, no landline, but no complaints because we were able to look for a little further north and see just how bad things were and are in Western North Carolina. Turning to the subject at hand, procurement using federal grant funds, or as I knew it back in the day when I worked for a regional council, purchasing. I think it's important to recognize that in any grant budget, there are 3 three basic elements, three combinations of kinds of expenses that are associated with that. One of those is people, salaries, wages, and fringe benefits, and other kinds of expenses that relate to the workforce that's going to carry out the grant program. The second is places, facilities, and other performance venues that have to do with where the award is carried out. And then there are purchases. And so with respect to travel, supplies, equipment, construction, which includes renovation, and contractual services, all of those are matters that the policies we're covering in this program are relevant to. Now, in some federal programs, and certainly in some federal agencies that administer those programs, procurement is front and center. Arguably, if you're dealing with money from the Department of Transportation or from Housing and Urban Development or even the Department of Interior, the likelihood is that if you mess up procurement, you've messed up most of the grant. In places like the Environmental Protection Agency, Department of Homeland Security, which of course is front and center these days, the procurement of services is a big part of what goes on in that environment. And in places like the Department of Health and Human Services, Department of Labor, and so on, procurement involves engaging contractors to carry out fundamental parts of the program of activities. But there's one other group that's always interested in this, and that's the inspectors general, the audit units of the federal agencies. And they very frequently are critical of grantees who don't do something that most of us do as a matter of course, that is, shop around and get the best deal that we can. Now, picking up on the slide deck, first thing to note is that there are some sources of authority that affect procurement by regional development organizations that don't come from the federal government itself. The Federal Office of Management and Budget assumes that you're not starting from a standing stop in the procurement area, that you already have, likely have, a set of policies and procedures for how your organization goes about buying things. And some of those policies and procedures may be as a result of state law that affects your organizational status or your organizational operations. In other words, where the state legislature has said, if you're a city or a county or a special district or a regional council of governments, then you are expected to behave in this fashion when it comes to purchasing. Some of those procedures may also be things that are adopted by your governing body. One of the things we're going to be looking at very shortly has to do with the dollar thresholds that various kinds of methodologies at the federal level are expected to be carried out under. Well, those dollar thresholds will probably look a lot rich to many organizations of the type that you folks represent. In other words, the feds, when they talk about a small purchase, the only place that it's small is the federal government. So, there are some things where your organization may have either had to adopt something or decided to adopt something that's even more restrictive than what the federal government does. Now, on slide number 6, we got a little bit of repetition there, but the major thrust of what we're talking about in this program has to do with policies that are imposed by federal funding agencies. And over the last decade, the Office of Management and Budget has been engaged in a major grant reform effort that initially was manifested in the issuance of something called Uniform Administrative Requirements, Cost Principles, and Audit Requirements for Federal Awards. And the short terminology for that is the so-called uniform guidance. That uniform guidance was issued in December of 2014 and was adopted on that date by 35 different federal agencies. Try to get 35 agencies to do anything on the same day, except maybe take it off, and you understand what OMB was up against. Well, they made a commitment to take a look at the requirements every 5 years. And they started off with that in mind in January of 2020. But something else showed up called COVID-19, which led them to pay much more attention to how those requirements could be modified to deal with the pandemic. And so some of the changes that were made in 2020 were really not that significant, although they were nonetheless incorporated into the requirements. Well, in February of 2023, OMB dusted itself off and began in earnest to take a further closer look at these requirements. And what the result is a set of rules that have now been consolidated and issued. They were published in April of this year, and they took effect last week, October 1st, 2024. So we are at a point where we're making a transition into some new policies that will affect procurement. Now, one other thing I want to mention, and this relates to the note at the bottom of page 6. One of the terms you'll hear people use a lot is the federal procurement requirements. And the problem with that term is that it's really not as precise as it needs to be. The federal government itself has a set of rules for how it engages in purchasing. Those rules are contained in Title 48 of the Code of Federal Regulations, Part 31. And that document is referred to as the FAR, the Federal Acquisition Regulation. That applies to the feds. It doesn't apply to you. So, make sure that you're in the right policy environment related to this particular function. Now, turning over to slide number 7, I refer to this as playing well with others because dealing with potential transfers of federal funds to other parties is something that goes on with respect to individual recipients of federal funds getting their awards from the federal government itself. One of the handout items that was provided to you as part of this program is a single-page chart called Sorting Out Federal Award Relationships. And if you look at that chart, what you see at the top is the federal government making a decision itself on whether it's going to engage in what's called federal assistance versus whether it's engaged in federal acquisition. The federal acquisition part of things goes back to what I just talked about a moment ago, namely the Federal Acquisition Regulation. That's the set of policies that the federal government deals with when it's buying something, whether it's a weapons system for the Department of Defense or a training program conducted for federal employees by somebody like me. On the other hand, if the principal purpose of the activity is to assist, stimulate, or support a non-federal party in the conduct of a public program authorized by law, that's referred to as federal assistance. And the first tier organization that receives federal assistance is referred to as a recipient or grantee. Now, that recipient or grantee can turn around and make lower tier relationships financially. One of those lower tier relationships involves issuing a sub-award to a sub-recipient. In that type of arrangement, the federal funds don't lose their identity. The sub-recipient is expected to spend the federal funds in the same way as the recipient did. In other words, there's a flow through of requirements. Alternatively, if what's going on is that the recipient is buying goods or services from somebody else, that's when the requirements that we're dealing with in this program kick in. And those requirements are an excerpt from the OMB uniform guidance. Specifically, and this is a copy that you've been provided, it is 2 CFR 200, 317 to 327. Now, that's about 6 or 7 pages of federal rules. It's interesting that the federal government can tell a recipient or subrecipient how to do purchasing in 7 pages. It tells itself how to do purchasing in the Federal Acquisition Regulation in seven thick books. So the level of detail that's present in the requirements affecting grantees is much more skeletal. Now, I mentioned earlier the term procurement because that's something that the federal agencies refer to this all the time as. However, again, my experience in local government many years ago was that the term was used was purchasing. If you look up procurement in the Merriam-Webster dictionary, or you look it up in Black's Law Dictionary, which is more precise, what you find is that it's bringing a buyer and a seller together. So in our mode, the buyer is the recipient or subrecipient organization. The seller is a contractor or entity that can be any type. You could be buying something from a governmental unit or from a nonprofit organization or from a commercial entity or even from a private individual. Okay. What matters is not the nature of the contractor, it's the nature of the deal. And the deal is buyer seller. Okay. Thinking it through one step further, when a recipient or subrecipient pays a contractor for value received, the federal funds lose their identity. And again, it doesn't matter what kind of organization that contractor is. That is earned income to that entity. Okay, so I'm sure many of you have wrestled with the issue of whether somebody is a subrecipient or a contractor, something else that the uniform guidance has wrestled with itself. But the idea here is that we want to make sure we're in the right environment, and that environment is purchasing. Now, slide number 8 focuses on some key concepts that are kind of overarching assumptions about this relationship. First, organizations like yours are allowed to rely on their organizational procedures to the extent that those procedures meet federal standards. Now, if we were dealing with a brand new organization that never had a federal grant before, and they were trying to figure out what kind of purchasing procedures they should use, they might be heavily relying on the template that the federal government has provided. But with organizations like yours, in most cases, you've already got a set of purchasing rules. Your concern is making sure that those rules align with the federal standards for handling this function. And so sometimes you have to tweak your own purchasing procedures to reflect a particular federal requirement. And we'll see that kick in a number of places during this presentation. So organizations may or may have to adopt policies that are more strict than the federal standards. The example I gave earlier about a state law requiring an organization to do something in a particular fashion, or even something that's enacted by your own governing body. Another important feature is what's called privity of agreement. And throughout the slide deck, you'll see numerous citations to 2 CFR 200 so that you can go back and see where it actually says that. But the important thing about privity of agreement is that the purchasing deal is between a recipient and a contractor. The federal government or a pass-through entity is not a party to a recipient or subrecipient's contracts. Okay. 318K actually talks about this and says that the recipient or subrecipient is responsible for resolving all matters related to its contracts, whether those are pre-award issues such as solicitation irregularities or award protests, or post-award contract administration, agreement interpretation, and any claims and disputes. If an awarding agency wants to get involved in this sort of thing, I've always found one of the acid tests is to ask them whether they want the liability for something going wrong in these arrangements. And they will very often, roll back and say, oh, no, this is your responsibility. Well, don't cherry pick, don't allow cherry picking in terms of that involvement. Now you might say, well, what's this last bullet on the slide all about then? Possible funding agency involvement. That particular section introduces the possibility that a funding agency can review your purchasing procedures or could request to look at the purchasing arrangement that you make for a particular transaction. Okay. But the fact that that is available to them doesn't mean that they necessarily undertake that kind of arrangement. Okay. But on the front end of a grant application, particularly if there's going to be a lot of purchasing done, it's not at all uncommon to have the awarding agency, request a copy of your purchasing manual and to take a look at it to see if it in fact aligns with the federal rules. Now, I'm somebody who has had a lot of interaction with the Office of Management and Budget over his career. And accordingly, I'm not at all reluctant to criticize them when I think they didn't do something particularly well. Well, when it came to the development of the purchasing procedures in the uniform guidance, I have to give them poor marks. Because first off, and this is still true the way it's presented in the material that's been handed out to you, it is a disjointed presentation. They jump all over the place in terms of the logical process that involves a purchase. And so, just for example, the section on contract administration is in the first paragraph of the rules, instead of putting it at the end where contract administration actually occurs. And so what I've got on slide number 9 is a listing kind of in a logical order of the things, the template for the policies and procedures that you should be using in this particular context. And so I'm going to try to stay with that as we go forward. The other thing I would say about OMB's activities in developing these rules is that it's very clear that the people who were involved, and OMB formulated a task group drawing from federal agency personnel who have grants management responsibilities, that OMB relied on in this particular subject matter, agencies that have a lot to do with state and local governments. Okay, state departments of transportation and various kinds of development activities. And so, for example, one of the things they put into the original uniform guidance procurement standards was that at the end of the solicitation process, where offers were considered and the decision was to be made about who the successful contractor would be, they were requiring organizations to have a public bid opening. Well, that's the kind of thing that goes on when a governmental unit is letting a contract for road repair or something of that sort. But when that came across the transom, universities, nonprofit organizations, and so on raised Cain about it and said, that's not the way we do business. And OMB actually had to withdraw that requirement because it was sufficiently controversial in that environment. So this list on slide number 9 is really one that mirrors what's going to go on during the life of a purchase in terms of a logical sequence of events. Now, let's take a look at these things in more detail. And slide number 10 gets to the issue of code of conduct, how the people who are engaged in the purchasing function are supposed to behave. OMB is concerned about a couple of things. One of them is conflict of interest. And there's discussion in the requirements related to what constitutes a conflict of interest from a familial standpoint. It says that, somebody who's a member of your immediate family is involved in the organization that's selling to your grantee organization, that you would need to recuse yourself from that arrangement. Now, OMB does not define what immediate family is, and they certainly don't go any further than that in terms of familial connection. But my experience is that a lot of organizations actually define what constitutes an objectionable familial conflict. Another one, which is closely related, is financial interest. If an individual involved in the purchasing decision has a financial interest in the competitors or a competitor, they are to absent themselves from that arrangement. And finally, organizational. Now, organizational really deals with self-dealing among organizations. And the government's concern here is that both the buyer and the seller are under common control. So you're not, you're not renting from yourself. You're not selling among entities that have the same governing body. And I know a lot of regional organizations have ancillary groups that they've formed, development corporations, foundations, and things of that nature, which are under common control. And so a dealing arrangement under those circumstances would be considered a conflict of interest. Now, the appropriate steps that are listed on slide number 10 are not contained in the regulation. They represent best practice approaches. So acknowledging the applicability of the code of conduct, determining the status of an individual in terms of whether they're covered, disclosing the conflict, and recusing from taking any action on the contract, and finally, enforcing teeth if necessary. So that if there's a violation of the code of conduct, there are consequences for the individual involved. It doesn't, there's nothing in the rules that says the person needs to be disciplined, fired, whatever. That's up to the organization to come up with those sorts of things. But from a common sense standpoint, the code of conduct isn't worth much if it's not enforceable. Now, on slide 11, there's another aspect of the code of conduct, and that is the solicitation or acceptance of gratuities. The section that's cited there makes it clear that a staff member or other party who's involved in the purchasing decision shall neither solicit nor accept gratuities from a contractor. Now, OMB turns right around and says that an organization can set standards for items of nominal value. So the idea, for example, that if you accept a pen or a coffee cup from a contractor, that you're somehow going to compromise the purchasing arrangement. So usually that involves an identification of the dollar value of the inducement, if you will. So don't accept anything more than $10 worth of something, or $20, something of that sort. I was thinking about the example of coffee cups, and a lot of people have got a coffee cup from Yeti these days, which is actually sort of the Mercedes-Benz of hot beverages. So you'll know it when you see it, but you need to have a policy related to that. And the federal rules allow a regional council to adopt greater restrictions, because then your own rules become the compliance standard. Later on in the presentation, I'm going to be identifying what might be called audit vulnerabilities. And you're going to see that the likelihood is that if you're doing a fair amount of purchasing in your federal grant activities, your independent auditor is going to be looking at whether or not that sort of thing has been precluded. Now, slide number 12 talks about acquisition planning. You won't see that term anywhere in the regulation, but it is certainly identifiable as the kinds of things that are expected for an organization to do as it considers whether to make a purchase at all. One of the things that the requirements say is grantees should avoid unnecessary purchases. Well, my response to that is, well, duh. Of course you should do that. But here's the problem. A lot of organizations, when they get a federal grant, they look at the budget and they say, oh, we can buy $50,000 worth of supplies. And what do? They go out and buy $50,000 worth of supplies, even if they show by their performance they didn't need to and can't use all of that. Okay. They also say consider purchase alternatives, such as leasing or borrowing or getting something gifted to the organization. And, think about that before starting down the road of actually making a purchase. Conduct market research. Find out who is out there who is selling what you're buying. And that includes getting help from places like the Small Business Administration, the Minority Business Development Agency, and the Department of Commerce, the federal agency's Office of Small and Disadvantaged Business Utilization. That's what OSDBU stands for. And even focusing on chambers of commerce that may be located in your service area. Consider engaging in cooperative purchasing. Now, that's something that certainly a lot of regional organizations are engaged in, but one of the issues that comes up in that context is that if you are buying off of somebody else's contract, as you may be able to do, say you're in your state, you're allowed to buy off a state government contract. You've got to make sure that the state government contract was entered into in the same manner that you would have to enter into it if you were doing the purchasing yourself. And that may look a little strange, but that I've seen organizations get written up, particularly by inspectors general offices, for failing to make that understood. Prepare should cost information. Now, this is something that's dragged over from the federal government itself. Okay. When the federal government buys things, they may be the only party that's buying the item or the service. Okay. Think about the Department of Defense. Who else but they are buying the kinds of things that they're buying? So what the federal government expects them to do is to conduct a should cost analysis. What should this cost if we were budgeting for it ourselves? Now, that was built into the rules, but for most of us, the should cost information is something that was built into the budget of the grant application. In other words, you decided how much you needed on a particular line item like equipment because you went out and determined what it would cost to buy the asset that's involved. So, relying on your own budget figures might be a way to accomplish this. Manage the supply chain. In other words, what needs to be purchased, when, where, and are there things related to pre-positioning and things of that nature? Geographic preference rules. Now, this is one where we can find agreement between Donald J. Trump and Joseph Biden, because in 2018, President Trump issued an executive order encouraging grantees to buy American. Okay, the language in the rules is sufficiently flexible that it's really an encouragement, not an absolute dead requirement. Well, when Biden took office, he rescinded Trump's executive order and wrote one of his own, which basically said the same thing. And there was a lot of that going on, and there always is. But the point is that the domestic preference, which is what the term is for Buy American, is a provision that's present in 2 CFR 200-322. The other aspect of this is that in the revision to the uniform guidance that OMB issued and that took effect last week, there is an absence of policy that is different from what we've dealt with for years in this particular arena. In previous OMB policies, it was stated that state and local preference could not be pursued. In other words, you couldn't say that an organization that you were purchasing from had to come from a particular location. That was very quietly dropped in the revision that took effect last week. And so, you're still expected to get competition. You're cast the widest possible net, but being able to restrict the purchasing to a particular location is not identified there. Finally, there's a provision that relates to encouragement of the use of recovered materials. Now, that encouragement is just what it says. Presumably in a solicitation, you would indicate that consideration should be given to whether materials that are recovered or recycled are able to be purchased. The only place in that discussion where there's a specific requirement has to do with state and local governments who are purchasing things that are involved in a regulation issued by the Environmental Protection Agency. It's a very narrow set of requirements, but because it's statutory, it's there. Now, slide 13, we focus on the issue of solicitation. How do we go out into the marketplace and obtain offers? This is where the acronyms that are presented there on slide 13 show up. Request for expressions of interest, request for qualifications, invitations for bid, requests for proposals. Now, one of the things that happens frequently is that folks conflate those terms. And you have a program person who shows up at your door and says, do we have to get bids? Well, if we're getting bids, then we're going to be selecting somebody based on price. If we're getting proposals, then the likelihood is we're going to have multiple factors that are involved with selecting the successful contractor. So calling it the right thing is certainly a step in the right direction. The components of the solicitation are not laid out in the rules specifically. There are a couple of comments, if you will, related to them, but the features of those solicitations really involve the features that are identified on slide 13. So structuring the purchase in terms of whether you bundle a set of requirements together or you break them out. One of the concerns that the federal government has is that if you bundle requirements together, you essentially reduce the likelihood that smaller and disadvantaged businesses will be in a position to compete. Okay. On the other hand, breaking out purchases into smaller pieces might be useful in getting competition, but it also increases the workload in terms of reviewing the offers and deciding who the successful contractor is going to be. Specifications and statements of work, they are differentiated based upon whether or not the needs of the organization can be definitized effectively, or whether there is some flexibility in terms of the way activities are carried out. And the bottom line of this is, what are the deliverables that a particular contractor, successful contractor, would need to be able to provide to the buying organization? Submission instructions involve standardization of what comes in the way of offers so that you can compare one offer to another on the same basic criteria. And those evaluation criteria, as I mentioned a moment ago, may be focused exclusively on price, or they may be involved with scoring an offer based upon multiple characteristics. So we usually use specifications when we're buying stuff like supplies and equipment. We usually use statements of work when we're buying services. Ultimately, certifications from the expected offers would also be provided at that point. For example, the idea that the offer is binding for a specific period of time. Slide 14 moves to the issue of competition. We use the solicitation to inform the marketplace of what we need. Now we're going out into the marketplace to try to get an adequate number of sources to generate and let the economy provide the best purchase. So casting a wide net is, I think, a good piece of advice. You can't control what the marketplace is going to do, but you can certainly take steps that would reach out to as broad a community as possible. One of the things that I think is still residually present in a lot of purchasing manuals is the idea that you would publish a notice in a newspaper having general circulation within your geographic area. The problem, of course, with that is there are fewer and fewer of those instruments having general circulation and being a reach out to the marketplace as a whole. Solicitation of various types of organizations is also expected, and 2 CFR 200-321 lays those things out. Now, the language that's present in 321 is also somewhat ambiguous in terms of making a decision about the applicability of the requirement. So, for example, one of the features is that it's considered to be restrictive of competition if you require an organization to have unnecessary bonding or insurance requirements. Well, it doesn't go any further in saying what constitutes such unnecessary requirements. The other thing that I want to mention, and I think this is probably relevant to a fair number of you, is that there are some special disadvantaged business enterprise rules that affect Department of Transportation assisted contracts, and they are contained in 49 CFR Part 26. The interesting thing about if you read that regulation, what it does is double back in the direction of the requirements that are cited on this slide, namely 2 CFR 200-321. So, in satisfying the OMB requirement, you will in all likelihood be satisfying the DOT requirement. Now, slide 15 starts us down the road of identifying the acceptable procurement methods. And the first of those is what's called a micro purchase. OMB says that any purchase of under $10,000 can be done without competition. Okay. Now, that doesn't mean that your organization can do that, because perhaps your governing body has said that your micro purchase threshold is $5,000 or $2,500 or something of that sort. So your organization can set a lower threshold, and no competition would be required under those circumstances. The second type of purchase is what OMB calls a small purchase. And that's a purchase that's larger than 10,000, but smaller than 250,000. Remember a few minutes ago, I said the only place where 250,000 is small is in the federal government. Well, once again, there is, flexibility for an organization to have a different set of threshold dollar amounts. And I suspect many of you would, given your, either your state law or local policy. One of the urban legends that's out there is that in soliciting the marketplace, you've got to get at least 3 bids or offers. I would challenge you to read this whole regulatory section, and you won't find anything about the number 3. Okay. What OMB says here is that you solicit an adequate number of sources. A lot of organizations choose 3 because of the assumption that if there are 3 offerers, that reduces the likelihood of collusion in the marketplace. They don't get together at the Holiday Inn and decide who gets the contract. The third method of purchasing is sealed bids. Now, I put competitive in brackets there because the assumption is that sealed bids do involve competition. And OMB lays out criteria for use of the sealed bid approach in the regulation. In the essential policy here relates to whether there are a sufficient number of competitors in the marketplace. And that's certainly true in, metropolitan areas. But, organizations that are headquartered in rural areas may have significant difficulty in, identifying and soliciting a sufficient number of competitors in order to make the purchase go forward. This competitive sealed bids, by the way, are preferred for construction projects. Competitive proposals are where multiple criteria for selection are generally used. And there are a couple of places that you need to be particularly mindful about. One of them is a requirement that is actually statutory. It's referred to as the Brooks Bill, named for a late congressman from Beaumont, Texas, that architect and engineering services would be competed based upon what's called qualifications-based criteria. In other words, you select the successful contractor based on their capability. Price cannot be a factor. The other thing to keep in mind is that single audit services, those of you that are required to do a single audit because you spend a threshold amount of federal funds annually during your fiscal year, 2 CFR 200-509 gets into some detail about how you're supposed to do that. And the notion here is that in trying to get a quality audit, the criteria that are included in that section are matters that need to be considered. Now, if you don't take anything else away from the methods of procurement, please take away the top of slide number 16. Non-competitive procurement or sole source. Under what circumstances can you engage in that sort of arrangement? Well, you've already run into one of them, which is your micro purchase threshold. The second is where there's only one source available. Now, you've got to know an awful lot about the marketplace to know that's the case. The third is emergency or exigent circumstances. Well, unfortunately, there are going to be a lot of grantees in North and South Carolina, Florida, and so on, who will be dealing with those kinds of arrangements. And the idea that you can dispense with your normal purchasing procedures because of emergency or exigent circumstances is certainly warranted. But, by the same token, months after a disaster has occurred and people are starting to get back on their feet, here comes the Inspector General of the Department of Homeland Security, who points out that when you're in a disaster, the first thing you should do is hold on to your wallet. Awarding agency authorization. You go to the awarding agency and say, we want a sole source with ABC company. Here's our justification for doing so. They look at that, they agree, and they give you a thumbs up or a thumbs down, okay? The best time to do that is during the application process rather than at the time the transaction is initiated. And then finally, and this is where the door cracks open just a little bit, you determine that competition is determined to be inadequate. In other words, you go out into the marketplace, you solicit offers, you don't get any, or you only get one, and you need to go forward with the purchase. It's your determination to make that decision. But in order to make that decision, you have to have gone through the process first. Now, time and materials contracts are just what they say. They are purchases in which you are paying for the time and effort of the contractor plus any materials they use. OMB says that this type of purchasing can be done, but it only should be done when there's no other type contract that will work, because the idea behind this is to put a cap on what the expenditure would be So a not to exceed amount is imposed, and it's expected that the recipient or subrecipient who places this kind of contract is going to have a strong monitoring role overseeing the contractor. Okay. A statutory restriction is that you cannot engage in a cost plus percentage of cost contract. The federal government can't do that, and neither can a grantee. And finally, intergovernmental or interlocal methods have to do with joint purchasing activities. The example I gave earlier about buying off of a state contract, or as some organizations do, joining together and soliciting for offers for a contract that will be larger because of its economies of scale. Slide 17 addresses the term source evaluation. Source evaluation means looking at the offers and determining from the offers who is a competitive offerer and who is in a position to deliver the goods or services. Now, in making that assumption, two factors come into play. Responsiveness, which has to do with how the offer is presented, that it gets there in a timely manner, that it's complete in terms of the instructions you've given for how it should be accomplished, and that it's correct in terms of specifics. From responsible contractors, what are the factors that can be considered? Integrity or past performance. Certainly relying on references is something that is common in this situation. Compliance with public policy. Now, that's a term of art the feds use, but what they mean is that the organization is following the rules for its own line of business. In other words, they are current with their tax payments. They are properly licensed, things of that sort. It doesn't go into detail about what all of those public policies might be, but it certainly raises the idea that you can use those policies as a way to screen out irresponsible contractors. Finally, financial and technical resources. Are they equipped and ready to accomplish what it is that you need delivered? Source evaluation and selection. Okay, we've gotten the offers in, we reviewed them, and we want to place a contract. Avoid black box purchasing. Now, that's a term of art that I ran into for the first time when I was training auditors at the Governmental Audit Training Institute. Black box purchasing is where all the offers go in one side of the black box. The successful contractor comes out the other side, and you can't determine what went on in the box. So the advisable documentation on slide 18 is the type of stuff that would permit you to have a transparent decision process. And the idea here is that somebody standing on outside could look at these pieces of information and conclude whether a proper decision was made. Cost or price analysis. Now, you sometimes see this referred to as cost and price analysis. It's actually or analysis. Price analysis is where the offers come in on a fixed price basis, and you're comparing one offer to another that have been responsive to the solicitation. In other words, all other things being equal, we're in a position to differentiate based on price alone. Cost analysis, on the other hand, is where the offers were solicited using a breakdown of different kinds of elements contributing to a bottom line price. So the idea here is that the purchasing organization is in a position to review the components that went into the bottom line and determine whether they represent what's called cost realism. Now, the term of art or terms of art that are used for that purpose are the costs necessary, are they reasonable, and are they allocable or beneficial? And, this is more than just adding up the arithmetic. It is looking at each of those things from a standpoint of, will the contractor have to spend that amount in order to perform the work? Finally, in dealing with that, it's expected that you would use the federal cost principles that apply to the type of offeror you're dealing with. If the offerer is a governmental unit, a nonprofit organization, an institute of higher education, a hospital, then 2 CFR 200 is the source of the cost principles. If they're a commercial entity, then the federal acquisition regulation cost principles are what you're expected to use. And you've got a citation there on slide 19 related to that. Okay. You've done your review of the offers. You have selected the successful contractor. What do you put in place? Now, here, I think OMB kind of punted. And the reason I say that is that back in the day before the uniform guidance was issued, there were separate OMB circulars for governmental units and non-governmental units. Some of you veterans will remember OMB circular A102 for governments and A110 for non-governments. Well, A110 had a very useful paragraph about the nature of the contract award. And it said that the recipient or subrecipient was to issue a sound and complete agreement. Now, that's a term of art that lawyers understand, that the contract has sufficient features in it to create enforceability in a court of law. But the notion of what that contract table of contents should look like is probably something that starts with the elements that are listed there. Showing an offer and acceptance by the contracting party, that there's legal content contained, that there is financial consideration, jurisdiction having to do with the law governing the operation of the contract, the obligations of both parties and any rights and remedies they have, and finally, severability. Now, that's not a complete list, but OMB is kind of assuming that if you need help writing a contract, you'll go and get help from a competent lawyer. What the government has also done, however, is say that in addition to all those kinds of things which are commonly expected, you're expected to include a set of federal public policy clauses. This is on slide 21 of your handout, okay? Those clauses are contained in 2 CFR 200, Appendix Roman numeral 2. And this is a case where, again, I'll be critical of OMB in this respect. The list of policies that are there represent either a statutory requirement or a requirement that arises out of a particular executive order issued by a particular president, or they kick in because of the nature of a particular type of contract. Well, what a lot of lazy lawyers do is they take Appendix Roman numeral 2 and attach it to the other terms and conditions of the contract. And in the introductory paragraph of Appendix 2, it says, follow these as applicable. So some of them will not apply to a particular contract that you might engage in. But, in a sense, by simply putting it in there and adopting it by reference, the lawyer is taking the approach that if something applies, it'll stick to the wall. And if it doesn't apply, then it'll be a nullity. We won't pay any attention to it. Well, I think if I'm trying to get a contractor to take my contract seriously, I want to make sure that the contract requirements that really do apply are presented to them accurately, and that those that aren't are things that I prune out of that contract. But that's, that's just me talking. That's, I think it's a much more precise way of doing business. But just as an example, there are several of the clauses that apply because of the nature of the activity, namely construction. The Davis-Bacon Act, for example, doesn't apply to every federal grant program. In the Davis-Bacon Act regulations, there's a listing of some 65 statutes under which a program is expected to incorporate the Davis-Bacon requirement. And for those of you who don't know the details here, the Davis-Bacon Act requires that on federal and federally assisted construction projects that are covered, the contractor will pay wages and wage levels set by the Department of Labor's Employment Standards Administration. So, this is something that was enacted during the Depression as a way to prop up the construction industry. And it's been around since 1931 with a number of additional programs being added as Congress decided whether Davis-Bacon should be there or not. Now, let's go over to slide 22 and deal with the issue of contract administration. 2 CFR 200-318B is where this is presented, and it's very skeletal. There are only 2 sentences that describe what's involved. The idea that contract administration would determine whether the contractor performed in accordance with the terms and conditions of the award and whether they complied with them. How that's to be done is left to the devices of the recipient or subrecipient that's doing the contracting. So the question of including access to the contractor and its records, avoidance of interference with the contractor's performance. At common law, it's not uncommon to see a situation where a contractor is penalized because of lack of delivery or some other problem, and their defense is that they were interfered with by the buying organization. So avoiding that sort of thing is certainly appropriate. What tools are available? Well, this is, again, a best practices approach because OMB doesn't lay that out. Conducting oversight of the process of delivery, assuring that delivery occurs in a timely manner, that there's inspection as appropriate, and that certainly would be the case when you're buying equipment or supplies. Acceptance, which constitutes the transfer of ownership from the contractor to the organization, payment, and warranties. Now, if you compare what goes on in a purchase contract relative to oversight compared to what's expected if you are dealing with a subrecipient, it's really a night and day situation, okay? If you're a pass-through agency dealing with a subrecipient, there's a whole laundry list of things you're required to do that are contained in 2 CFR 200-332, okay? Review financial and performance reports, determine whether there are any audit findings related to the funds that you provided, issue a management decision related to any of those audit findings, consider the imposition of special conditions if corrective action doesn't take place. And then it goes on to say that you've got the right to conduct site visits, to arrange for agreed upon procedures audits, and to provide training and technical assistance to subrecipients. It's a whole different kettle of fish when you're dealing with that type of relationship. Whereas with a contractor, the assumption is that the contractor came fully equipped and ready to work, and that providing them with, if you will, hand-holding is not something that you're expected to do. So, keep that in mind when you have both of those kinds of instruments going on. Don't conflate the two and end up, doing some things that you don't need to do. Slide 23, procurement records. Now, this will enable you to avoid the black box purchasing warning that I gave you a few minutes ago. Explicitly, OMB lays out that at a minimum, the procurement records will include the last 4 elements on this slide. The rationale for the procurement method used: micro purchase, small purchase, competitive seal bids, competitive proposals, non-competitive procurement? Which one of those did you use and why? What's the rationale for the contract type used? And what do they mean by contract type? Whether a fixed price was an appropriate mechanism or whether some form of cost type contract. Okay. Notice I didn't say cost reimbursement. Okay. Cost type has to do with what the element of settlement would be. So a cost plus a fixed fee, cost plus an incentive fee, something like that. Cost plus a percentage of cost not authorized. Source evaluation and selection process and the result. So, going back to the documentation suggestion that I made on an earlier slide, those are the sorts of things that you would be expected to show in your procurement records. And then finally, the basis for the contract price, whether you engaged in price analysis on a fixed price basis or cost analysis where the individual costs that went into the bottom line price were analyzed as well. Now, I'll say this one more time. If you don't take anything away from this procurement discussion, please take away what shows up on slide 24. Okay. The Office of Management and Budget every year publishes something called the Compliance Supplement. It is a gigantic audit guide. The most recent one issued in June of 2024 is over 2,000 pages long. But it's really a kind of a dictionary of where the auditor is supposed to go to find the requirements of a federal program that's in the hands of their auditee and identify the requirements they're supposed to check on and suggests audit procedures for how that checking would take place. Well, in the compliance supplement, there's an individual section related to 12 policies that are primarily driven by OMB's uniform guidance. Allowable cost principles, cash management, program income, and so on. Well, one of the so-ons is procurement and suspension and debarment. Okay. And if you read that particular section, which is part 3I, several pages long, and you can download that section from OMB's website, you find that the issues that they are expecting an auditor to pursue are the ones that are listed on this slide. Do you have written procurement procedures? Do you have standards of conduct written into those procedures? How do you use the acceptable methods of purchasing? How do you obtain competition? What's the procedure you've used relative to geographic preference? Did you need to conduct cost or price analysis, and did you do so? Did you include the clauses that are necessary from the list that are contained in Appendix 2? Did you make awards to responsible contractors? If I had a flashlight right now, I'd be flashing audit alert because checking to see whether the contractor has been suspended or debarred and is listed in the excluded parties list system of sam.gov is a procedural step that you're expected to do. And auditors love this one because if you didn't check the suspended and debarred list, you not only didn't comply with the requirement, but you also have a weakness of internal control for not having done so. So they end up with a twofer in terms of an audit finding. And the funny thing about this is a lot of organizations assume that if they get a certification from the prospective contractor, that takes care of this. It doesn't. I mean, a prospective contractor can, submit an offer and say, well, we're not suspended or debarred. The key element here is, did you check to find out whether that was true? And I can't tell you the number of auditees that I've seen get written up on this one, and it be, a problematic finding, even though if you had actually checked, you'd find out that the contractor isn't on the list and everything would have been fine. Finally, What kind of oversight did you exercise in order to get what you paid for? And do you have the required records that were included on the previous slide? Now, just one final comment before we open it up for uh, any questions or comments. I've included in the slide deck a discussion about inventory and asset management. In other words, how do you take care of the stuff that you bought? And this is particularly important with respect to equipment. Now, the uniform guidance has a revision in it that took effect last week, including a new definition of equipment. The previous definition had two elements to it. Equipment is a piece of tangible personal property having a useful life of more than 1 year and a unit acquisition cost exceeding $5,000. Okay. When you do a budget for a federal agency and fill out the standard form 424 application, you put any items that meet those two definitions, 1 year and 5,000, in the equipment line item, and things that don't meet that definition in the supply line item. Well, what's happened is that OMB has bumped the numbers. Now, going forward, equipment is something that has a useful life of more than 1 year and a unit acquisition cost exceeding $10,000. Now, one other note to keep in mind here. The fact that the feds define equipment and supplies that way doesn't mean that when you end up with it in your inventory, you have to use the same numbers. Okay. This is another case where I suspect many organizations of your type are defining equipment at a much lower dollar threshold. It was equipment for federal purposes if it was exceeded $10,000. It was equipment for your purposes in terms of keeping up with and maintaining control over your assets. And you might be defining equipment at $500 or $1,000 or some other number. Okay. So I'm sure what a number of organizations have been considering doing is if they've been following $5,000 in the past, they may be deciding to bump their threshold up to 10. And, if they're comfortable with that, they're okay in so doing. But, the point I'm making is that, once you've acquired something, how you manage it is where your own policies may be more restrictive than what the federal governments are. Here's one more audit alert on slide 26. Equipment management standards. Auditors love this one because you need to have equipment records that have required data elements contained in them. Things like the serial number, the current location, the extent to which the federal government participated in the purchase. And so if those data elements are missing or it's otherwise problematic, that could be a finding. A periodic inventory, at least once every 2 years, that verifies that the assets you have are still around. Control procedures to prevent loss, damage, or theft. Things such as security procedures, insurance arrangements, and things of that nature. Maintenance procedures to keep the stuff in good working condition. And finally, disposition procedures that provide for competition and that will result in the highest possible return. Now, this is where a dollar change in the policy has also arrived. Okay, if the previous policy was that something had a fair market value of $5,000 or more, then it was something that was subject to disposition requirements contained in 2 CFR 200. OMB, once again, has bumped that $5,000 figure to $10,000. So if something is valued at $10,000 or more on a unit basis, then seeking disposition instructions from the awarding agency is warranted. If it falls below the 10,000, an organization can retain the item, use it, sell it, do whatever they want with it, the federal government's writing it off. And that might shock you a little bit, but the federal government's running a $4 trillion operation. Something that's worth $10,000 at the end of a grant is not a significant matter to them. So, keep in mind those threshold changes, both from an acquisition standpoint and a disposal standpoint. Now, Dion, I think we've got some questions in the chat, so we want to
We
try
sure
to.
do, Bob. And we have two that are relevant to this slide. The first is simple. It's just, is the figure greater than 10,000 or greater than or equal to $10,000?
Good question. I believe it's 10,000 or more.
Fantastic. And then is the equipment management standards only for the period of performance, or is it for the lifetime of the equipment?
As long as you've got it, you're required to adhere to it. So let's say that you had a grant where you were able to buy a vehicle, and the grant is closed out. You're allowed to keep the vehicle. You've got to keep up with the data elements that are in that inventory requirement and so on. Because what the federal government doesn't want you to do is to turn around in another grant and charge them a depreciation or use allowance for something that they already paid for once.
Okay, great. I hope that was helpful to our questioner. Another question that we had asked earlier in the presentation is from Lisa. She says, how do you know if tax returns have been filed and taxes paid? Do you just ask for certification from the
I mean, that's a start. I mean, in the same sense that, I mean, the what's customary for governments and nonprofit or tax exempt organizations is the ability to obtain a copy of a tax return. I know, for example, in a lot of state governments, the State Department of Revenue will identify whether an organization is current with their tax information. So I mean, it's not a guaranteed arrangement that you'd be able to do this, but certainly exploring the possibility and asking for the certification from the offerer. Are you current with all tax responsibilities? In the same way, asking whether they're a party to any lawsuits or any liabilities thereto. I mean, that kind of thing is not an uncommon kind of question to ask an organization. And self-disclosure is certainly possible.
And then switching gears, we just had a new question come in from Monique. She says, do you have any recommendations on how our governing body can advertise our RFP or RFQ throughout the US instead of just locally?
Well, I mean, there are some organizations that provide that kind of service. The perhaps looking to issues of associations that represent the kinds of contractors that you are seeking would certainly be a possibility. But that this is where some of those technical assistance organizations, like the Small Business Administration and the Minority Business Development Agency and so on, may be able to help because they've been around long enough to assemble those kinds of pieces of information. I mean, another possibility might be to to Google the words cooperative purchasing and see what comes out of that in terms of other organizations. But I mean, I guess my question would be, there's a big difference between soliciting locally and soliciting nationwide, and there's probably some increments in between where doing something that's statewide or region-wide might be something that's a lot more doable, if you will.
Great, that's very helpful, Bob. And now since we have 10 minutes remaining in our scheduled time, I'm going to invite anyone who has another question to go ahead and just come off of mute and ask it yourself. But before we do that, I want to remind everyone who's listening that NATO's annual training conference on October 21 through 24th will feature two sessions from Bob Lloyd. So if we didn't get to a subject that's of interest to you in this four-part series, it's still not too late to register for that conference, and you can find that link at nato.org/events. Oh, but before we open it for anyone to speak, I'm gonna get to Lisa's question here. Would a screenshot of a post on a public website satisfy proof of publication instead of or in addition to a newspaper ad?
Yeah, I mean, that gets to the issue of what constitutes acceptable evidence. Okay. And there's a lot of discussion about evidence in the government auditing standards that apply to single audits and audits conducted by federal inspectors general. And it goes to the issue of the type of evidence involved. And documentary evidence, including things that are electronically generated, are something that's been considered as valid um, for audit purposes. Um, another aspect of that evidence is testimonial evidence that the individual who went through the process of generating that is in a position to verify that they took the appropriate steps, that sort of thing. Physical evidence itself may also be worth considering under those circumstances.
All right. Anyone is now welcome to unmute yourself and ask a question of Bob.
Bob, can you explain cost plus a percentage of cost contracts, just so I fully understand that?
Okay, sure. Basically, the idea that the percentage of cost is a reward for generating a high degree of cost in the performance of the agreement. In other words, uh, without the preventative measure of establishing a not to exceed amount, an organization could kind of create a a run on your treasury, if you will. And so this is not something that precludes a contractor from having an indirect cost rate, because that is actually a cost-based arrangement. But the idea that they're going to earn what amounts to profit because they've spent a significant amount on time and materials, that's what they're trying to drive at here.
Thank you.
Anything else in the queue?
All right, then seeing no other questions, I guess we'll go ahead and conclude today. Bob, I want to thank you again for taking the time to lead this session. Oh, maybe one more question from Monique. She says, what Black's Law edition should we get?
I think it's the 14th edition now. But this is probably something that a reasonably large public library would have in their reference section. In fact, one thing that kind of an ancillary suggestion to you is to find out where within reasonable geographic distance there is a U.S. government depository library. That's a term of art that the National Archives has for libraries that have a collection of significant government documents, like the entire United States Code of Laws and the entire Code of Federal Regulations, and receives a subscription on a daily basis to a hard copy of the Federal Register. It's that sort of thing. And, nationwide, there are probably 1,000 or 1,500 of these libraries that have sought to get the designation because they've got the right collection at hand. And so, a lot of large university libraries are in that position. Certainly the state library in your own state. But, checking in with them and obtaining either interlibrary loans or even access through the internet is something that I find very, very helpful in dealing with all this stuff.
Great. Okay, with that, we'll go ahead and wrap it up. Thank you everyone for participating, and hope you all have a great rest of your day.